Welcome to this video where we're going to talk about double declining balance, or otherwise known as accelerated depreciation. As you recall, depreciation is a journal entry that we do to monitor the loss of value in an asset that we own that is an asset that's not a current asset. It's a long-term asset. And so the assumptions we make here don't need to be exact, but we're trying to get to a ballpark. And a double declining balance or accelerated depreciation, this is another way to calculate depreciation expense. So we'll go back to Guilfoyle's example that we used in the prior video, where we used the straight line method. There was equipment cost and we just did a peanut butter spread. This is kind of just basically saying, okay, how much do we use? Let's just spread it over the life of the asset. The annual depreciation expense is cost minus the residual value over the estimated useful life for straight line. And it was 3,000, 3,000, 3,000 each year for the depreciation expense, and accumulated depreciation built up an account of 3,000 plus the extra 3,000 until it was 9,000, the total value of the equipment that we purchased. Now, double declining balance, it basically accelerates the depreciation forward. So you have a higher amount of depreciation compared to straight line in the first year and a lower amount of depreciation compared to straight line in the last year. And so double declining balance offers an incentive to expense more earlier. And a lot of people like this for tax purposes, in the sense that if you have accelerated depreciation is allowed on your books for taxes, that means you have lower income to be taxed by the government. So the other advantage of this is it kind of follows what we think about when we think about the value of a lot of equipment that we own. Usually the value goes down quickly in early years, and then it kind of goes stagnant over time. So double declining balance applies a fixed depreciation rate, a percentage, to an asset's net book value, purchase price less accumulated depreciation at the start of the year. The fixed depreciation rate percentage is twice the no salvage value straight line depreciation rate. What does that mean? We've got a formula that explains it. What we do is we take the cost of the asset minus the accumulated depreciation over the estimated useful life times 2. Why times 2? Because it's double the declining balance. So what we do is we take the cost, net the accumulated depreciation, divide it by the estimated useful life, multiply it by 2. That's what we use for our annual depreciation expense. So double declining balance ceases when the book value equals the estimated salvage value. And so let's go through an example to explain what this is. So let's use Guilfoyle's server under this accelerated depreciation double declining balance method. Equipment cost of 9,000 as a review, residual value is 0, and estimated useful life is 3 years. Our annual depreciation expense formula related to double declining balance will be cost minus the accumulated depreciation. You notice in the other one, it was cost minus salvage value, or cost minus the remaining value that you'd have when you'd sell it. This is cost net accumulated depreciation over the estimated useful life times 2. That's what the formula is for double declining balance. So in the first year, we're going to take 9,000 minus 0. We don't have any accumulated depreciation in the first year, so it's 0. So 9,000 minus 0 multiplied by 2, and that 2 right there is the same as this formula here. And then we take we take that over 3, and what do we get? We get depreciation expense of 6,000. And accumulated depreciation of 6,000. So depreciation expense in the first year is 6,000. What was it in the last problem on a straight line? 3,000. So it's double. It's double in that first year, the depreciation of what we'd normally depreciate under straight line. In year 2, we take the 9,000 and we take the net accumulated depreciation that we have on it, which is 6,000, which will give us 3. Multiply it by 2, and then divide by the number of years of the estimated useful life. And the depreciation expense is 2,000. Accumulated depreciation is 8,000. And then in the final year, year 3, we take 9,000, we minus 8,000, which will give us 1,000, because that's our accumulated depreciation up to that point. We take that, multiply it by 2, and then divide it by the number of years, 3. And our depreciation expense is 666? No. This is the final year, and this is what happens in double declining balance. The double declining balance accelerates quickly, and in the final year, there is a plug, essentially. We actually plug the remaining value. The value's gone, and so in the final year, we report 1,000, even though the calculation has 666. A lot of you are like, wait, what? Yep, That's what we do. In the last year, if the value is gone and this is your assumptions, you don't stick to the formula, you stick to the assumptions. And the assumption tells you, yes, the 1,000 needs to be reported in that final year. And so that will be our depreciation expense, and it will be $9,000 in depreciation, accumulated depreciation. So what's the net value on the books? 0. That's the net value of what it is on the books. So let's go through the journal entries for this. Accumulated depreciation in the first year is going to be 6,000. Depreciation expense first year is going to be 6,000. So 6,000 gets credited to accumulated depreciation. We're maintaining a credit balance on this on our assets because it's a contra asset account, this accumulated depreciation. And our depreciation is 6,000. And that will be debited, all right? And what is the net equipment value on the books after year 1? Well, we bought them for 9. Accumulated depreciation is 6. The net value is 3. Okay, great. Accumulated depreciation year 2. Well, we did the calculation. We saw that it was $2,000 what we depreciate in year 2. So $2,000 gets added to accumulated depreciation. And we'll have a journal entry there of a credit for accumulated depreciation of $2,000. And then we're going to have depreciation expense of $2,000 in year 2. And that depreciation expense will show up here as a depreciation expense debit of $2,000. And the question comes, well, what is the net equipment value on the books after year 2? Well, what's the net, what did we buy it for? And what's the accumulated depreciation balance? Well, we reported $6,000 of accumulated depreciation the prior year. This year we reported 2. So that means we bought it for 9. Then the total that we have on our accumulated depreciation is 8. So the net equipment value is $1,000. And let's do year 3. Year 3 accumulated depreciation is $1,000. Year 3's depreciation expense is $1,000. Remember, it's not the $666 that the formula would give us. It's our last year. We have to put the rest of it off. So, and that's double declining balance. I have one more example for you. Of units of production, and then I'll also have another video on double declining balance just so that you can get a longer calculation period so that you can see how to do this over longer periods. So I'll see you in the next video where we'll talk about units of production, and then we'll do another double declining balance example.